It was one of the most contentious takeover battles in Wall Street history, the leveraged buyout of RJR Nabisco, orchestrated by private equity firm Kohlberg Kravis Roberts, or KKR. A debt-fueled deal so iconic and controversial, it became the subject of a best-selling book, Barbarians at the Gate, and a made-for-TV movie.
No matter who wins, the company will be impossible to manage because the debt load will just be crushing.
22 years after that deal, KKR is finally making its debut on the New York Stock Exchange. It had planned to sell shares 3 years ago, around the same time as rival Blackstone. But while Blackstone's IPO went forward, KKR pulled out when markets went sour. Analysts say even now it's still a challenging environment for buyout firms.
The LBO market is really dried up. I think that there's some opportunity out there, and KKR has a lot of cash on their balance sheet now. So I'm not sure that LBOs are what this is about. I think that they do see additional opportunity elsewhere in providing financing outside of that market.
Experts believe KKR is listing on the NYSE to accelerate its transition away from leveraged buyouts and toward areas like asset management. To be sure, KKR is still heavily involved in traditional deal-making. 3 years ago, it launched a $43 billion takeover for energy giant TXU and is reportedly raising millions of dollars for oil and gas investments. Its Wall Street listing is expected to lead to a hefty payday for KKR's two remaining founding partners, Henry Kravis and George Roberts, cousins who launched the firm in 1976. But as for the average investor,
you definitely want to show some caution when investing in firms like this. Blackstone Group, Fortress Group is another one. Both of these firms made billionaires out of their senior partners, but for the retail investors, their stocks have performed horribly. Blackstone is off 2/3 of where it was when it went public.
Private equity firms going public and facing challenging times. Patricia Wu, CNN, New York.